If you wanted to build a portfolio that could, let's say, generate $1,200 a month in passive income, how would you do it? How would you do it the traditional way? Well, you'd probably start off by doing some research. You'd probably look up 20 to 30 different blue chip dividend stocks, buy them, add them to your portfolio. And at that point, you'd be managing a portfolio worth roughly 300 to 400K. And then you'd get a 4% dividend yield, not too shabby. That's a lot of work, and that is a lot of capital. Now, what if I told you there are 3 new ETFs in the market today that claim they can generate that same amount of income for less than a quarter of that capital required, and on top of that, get you paid twice a month passively? This is a seductive promise of Hamilton's brand new lineup called the DayMAX ETFs. Enter CDAY, SDAY, and QDAY. And I know many of you watching this video are always on the hunt for the best monthly paying dividend stocks or the best monthly paying dividend ETFs. Well, these new ETFs that I'm talking about promise to pay you twice a month just like a regular paycheck. They offer the simplicity of an index fund, and income generation like a hedge fund, delivered to you twice a month like a regular paycheck. As an accountant, as a CPA, when I see a combination like this with that type of advertising, I don't get excited, I get suspicious. Let me show you what I mean. My first question is always, where is that money coming from? And what is the price you have to pay to get it? To understand the trade-offs, we need to look at the engine and how it works. The engine has 3 specific components. First, the foundation, which is fairly simple. These ETFs get their market exposure by holding other big diversified index ETFs. For example, we have here CDAY that holds the Canadian blue chips, SDAY holds the US blue chips, and QDAY holds the NASDAQ 100 index. This feels safe. This feels familiar, right? What could possibly go wrong? But the second part, the income engine itself, is anything but familiar. These ETFs use an aggressive option strategy, primarily using 0-day to expiry or 0 DTE covered calls. Have I lost you so far? The best way to explain it is with an analogy. It's like you are renting out your portfolio's potential for growth one day at a time. And look, to be fair, the prospectus does state that the manager has the discretion to write call options on a lesser percentage of the portfolio from time to time. However, that same document also mentions that they have the right to write call options up to 100% of the portfolio's value. This means that the fund manager has the discretion to completely cap your upside potential if they choose to do so. But that's not all. The prospectus also reveals that the fund manager has the discretion to write cash covered put options. This is a different income strategy where they get paid a premium but take on the obligation to buy the index if it drops to a certain price point. This just adds another layer of complexity and risk under the hood. The final part of the engine is the amplifier, the 25% leverage. That means for every $100 you put in, the fund immediately borrows another $25 to invest. This magnifies income, yes, but it's also a double-edged sword because it also magnifies potential losses. This creates a nasty effect called the volatility drag. Leverage makes a 10% drop much harder to recover from, especially in choppy markets. And I'm going to show you with just simple math in a quick moment why the high yield can't save you from this. So far, we've talked about the theory. Let's get straight into the numbers, which I know is what you love. Here are the stats from Hamilton's own website and their prospectus. Across all 3 new ETFs, you're going to find that they all have the same type of leverage at 25%, and they all come with the same management fee at 85 basis points. Now, it's critical to remember, this number is not the final MER, the management expense ratio. The MER includes costs like operating costs and taxes, and we won't know the full all-in number until the fund has been operating for at least a year. But I can tell you this much, fully expect that number to be much higher than the 0.85% that we've just been taking a look at. To put things into perspective, you can buy a simple S&P 500 index fund for less than 10 basis points. So you are here paying significantly more for a complex income strategy. And that money goes out of your pocket. It's crucial to also understand that this flashy target yield or this large upfront distribution, it is not a guarantee. The distributions aren't fixed like a bond payment, and that is written directly into the prospectus. The income these funds get from selling options premium really depends on how choppy the market is. Distributions can and likely will change from month to month. Just take a look at HMAX as an example. Anyone basing major financial decisions like retirement on these payments needs to be fully aware of this fact. But here's the most important tip that I can give you. As an accountant, when I look at these funds, the first thing I do on any given ETF is scroll right down to the tax section. Now, because these DayMAX ETFs are brand new, we don't have a full year's worth of distributions to analyze just yet. However, we can take a look at other high yield covered call ETFs in Canada as a guide. So, for example, based on those, it's highly likely, and again, this is using Hamilton's own website, that a significant portion of these ETFs will be classified as return of capital. What this does is that it creates a tax time bomb that I'm going to diffuse for you next. So, what's the true cost of that juicy yield we saw earlier? Well, you are paying for it with your future growth, and that's going to cost you more than you think. Financial research is crystal clear on this. The vast majority of the stock market's long term returns come from just a handful of its very best days. These DayMax ETFs are structurally designed to shade the peaks of those best days, almost guaranteeing you underperform on the most important days for long term wealth building. And here's a brutal irony in all this: the market's best days typically happen immediately after the market's worst days. An investor in DayMax ETFs is going to feel amplified pain on the way down because of that leverage. And then you are structurally blocked from fully participating in that powerful rebound rally that creates true long term wealth. This combination of amplified losses and capped gains is a systematic drag on your capital. I know what you're thinking, and I see this in the comment section all the time. Who cares if the ETF price goes down a bit? I'm getting a juicy 18% yield. I'm just going to take that cash and reinvest it. This is the most dangerous trap in high yield investing, and I need you to hear this loud and clear. Your yield is not your total return. Let me prove it with some simple math. Let's say you invest $10,000 into an ETF with an 18% yield. For the year, you're going to get, let's say, $1,800 in cash distributions because of that 18% yield. You feel amazing. You feel great. You got all that cash. But what if during the same year, the actual unit price, the net asset value, goes down by 20% because of that systematic drag we just talked about? That means your $10,000 investment is not only worth $8,000. That's a $2,000 loss for you. So let's do the final calculation. You received $1,800 in cash, check, but you lost $2,000 in capital, check. That means your total return is a net loss of $200 or minus 2%. You felt rich as the cash at your bank account, but your net worth actually went down. The fund was simply liquidating your own capital to pay you income. You can't reinvest your way out of a strategy that's built to pay you income by eating away at your original investment. It's critical that you understand that a huge part of that juicy distribution isn't actually profit, it's just the fund handing you back your own money. Think of your investment as a cookie jar. The cookies inside that cookie jar are your initial investment. A return of capital is effectively the fund manager reaching inside that cookie jar, grabbing one of your cookies, and handing it to you. Feels like income in that moment, but clearly it's not. Now, I see a specific comment on videos about covered call ETFs all the time. Someone will say, hold on, you're missing the point. There's good rock and bad rock. That is a very sophisticated point in isolation. But from an accountant's perspective, it dangerously misses the most critical point. And the truth is, the CRA, they don't really care if it's good rock or bad rock. If it's classified as return of capital on your T3 slip, the tax impact is exactly the same. Both good ROC and bad ROC, they both reduce your adjusted cost base dollar for dollar the same way. It doesn't really matter why the cookie was taken from the cookie jar. The cookie jar is just emptier and your tax bill is bigger. That's what matters. When you eventually sell the ETF, your capital gains tax is going to be massive because your adjusted cost base has been ground down to almost nothing. And with tax laws constantly in flux, a future tax liability could be larger than you initially think. We saw this earlier where initially the Liberal government was going to raise the capital gains tax rate. Then they said, JK, we changed our mind and we're not going to change it, right? So you get the point. Tax laws can and will change. You don't want a larger future tax bill. The uncertainty is a real risk here. When you ultimately sell the ETF in the future, those tax laws could be different. They could be better, they could be worse. We don't know. That's the risk. And here's the most critical warning of this video. If you are going to invest in these funds or these types of funds and put the money in your TFSA or FHSA, then I have news for you. The US government charges a 15% withholding tax on dividends paid to foreigners. In an RSP, a tax treaty protects you from this, but in a TFSA, that treaty does not apply. The 15% tax is taken, it's gone forever, and you can't claim it back. It's a permanent, unrecoverable drag on your returns, happening year after year, completely undermining the tax-free nature of this account. Just something for you to keep in mind if you are considering the FHSA or the TFSA for these types of ETFs. So what's the conclusion here? You've obviously invested some time watching this video. What's my take on this? Who are these ETFs for? Well, here's my final verdict. And I want to be super clear here. These are not replacements for your core long-term holdings for your portfolio. These are highly specialized tools, financial products for very specific investors. So who are these ETFs for? Well, in my view, these ETFs are targeted for income seekers who need the cash for day-to-day expenses, not necessarily for those who are just going to collect the cash and reinvest the distributions. Now, obviously, having said that, there are exceptions to the rule. If you are an income seeker who wants to collect that cash and it's a way that you psychologically feel you can better compound your returns, then sure, consider these ETFs. Who might stop you? But more so, this is for your educational purposes on how these ETFs work and the risks associated and the tax impact of these ETFs. The high cash distribution, getting paid twice a month, those are the primary features of this ETF. To me, they're designed for spending, not accumulating. If your main goal is to build wealth over the long term, and you don't really care about the distributions, or you're just going to take the distributions and reinvest them anyways, then this strategy is kind of counterproductive. You would be fighting a structure that is systematically designed to have its growth capped, and that's a powerful drag on compounding. A financial product is just a tool. Just like a hammer is good for a nail, but terrible for a screw. The DayMAX ETFs are specialized tools that are designed for cash flow generation. But if your job is long-term wealth accumulation, then these ETFs are the wrong tools for the job. This forces you to answer the most important question in your financial life. Let me know in the comment section. Are you a long-term wealth accumulator or someone who's looking to prioritize cash flow right now? There's really no wrong answer, but knowing which type of investor you are is the key to build everything around you. If this breakdown helped you better understand how these high yield covered call ETFs work, then hit that like button, hit that subscribe button. It lets me know this is the type of content you want to see more often and lets others find this type of content as well. That's all for now. I'll talk to you in the comments section.